For emerging markets like India, there are reasons to be worried about the US inflation. Rising inflation in US is a new risk for India's financial market. So what would be the impact of US inflation and interest rate dynamics on the Indian bond and the stock market? How Indian policymaker and the RBI should prepare to avoid a financial meltdown and its impact on the macroeconomic fundamentals. Let's find out. The US retail inflation is moving up higher than the target of the central bank. The rising inflation could be transitory because of the supply side disruption post-COVID. But a massive fiscal stimulus is raising fears of US inflation in the medium to long term. US Federal Reserve will also have to prepare to wind down its large balance sheet, which started increasing post-2008 global financial crisis. The inflation fear are for real. Take for instance, the cryptocurrencies and the US stock market are already witnessing a sell-off. In the last 2 years, the emerging markets like India have got the advantage of surplus global liquidity and the near zero interest rate. A part of this global liquidity has moved to stock markets and other asset classes like real estate and gold. Take for instance, the Indian stock market got the highest net inflows in the last decade at Rs 1,70,000 crore in calendar year 2020. A similar pattern of high foreign investment was seen post the 2008 financial crisis when the US was pumping in surplus liquidity to save its economy. Any normalization of monetary policy in the US is not a good news for India. A part of this money invested in emerging markets will go back to US and other markets for risk-free returns. There will be far-reaching consequences for Indian markets if the dollar outflows are in large numbers. First, it has the potential to weaken the currency value against the US dollar. A depreciated currency also means a higher price for imported items like consumer electronics or the crude oil, which are the largest imported items. The inflation will also come in via higher commodity prices and other imported inputs. The inflationary pressure is already increasing in India. The retail inflation or the consumer price index at 5% is very close to the upper limit of 6% targeted by the RBI. The wholesale price index or the WPI inflation has already hit the all-time high of 10% plus in April last month. The bond yields are already hardening despite RBI's move to pump in liquidity. Higher bond yield means higher borrowing cost for the government and also the corporate sector. And if the RBI intervenes to arrest the rupee depreciation, the foreign exchange reserve will go down. This will impact the country's external position as India runs a high current account deficit. India should prepare now for a monetary policy normalization in the US in the near future. Global rating agency S&P has already said that India and the Philippines stand the most vulnerable at the current juncture. First, India should keep a check on its fiscal deficit number. The fiscal deficit of 9.5% of GDP in the pandemic year and the projected 6.8% in the current year have already crossed the 6.6% level recorded in 2009 and 10 post the global financial crisis. Experts have doubt about the government's 5-year fiscal consolidation path of achieving 4.5% fiscal deficit by 25-26. The COVID second wave is already going to impact the budget projections as slower economic recovery means lower tax revenues. In fact, the past 10-year track record of fiscal consolidation is not very encouraging as we have never reached the target of 3% level despite oil advantage and higher growth at the start of the new decade. There is also a looming risk from loan restructuring and regulatory forbearances in the banking sector. Banks have entered the COVID crisis with 8% gross NPAs. Banking system and the NBFC sector also needs a cleanup. Banks needs to raise capital, especially the public sector banks. The good part is that the country's foreign exchange reserves are on the higher side. India's external debt is also not very large, but it is certainly time to prepare for a worst case scenario, keeping in mind a COVID third wave and a likely downgrade in the country's sovereign credit rating.